We are back with Dan Rohinton, Portfolio Manager at IA Global Asset Management. He's got 3 ideas for you amid this trade war and fluctuating markets. So thanks so much for sticking with us. Danaher, a big supplier to the medical sector. What do you see as promising with this stock?
So starting out, really what we're talking about is a company that used to be an industrial firm that shifted almost to a pure play on the healthcare side. And what they end up doing is they have diagnostic businesses, they have bioprocessing. So all the way from diagnosing that you have the flu or other types of, or COVID during the past, and still the case, you're talking about a company that's basically diversified across different parts of the healthcare production ecosystem. Mm-hmm. But the real story here today is that they're going through what was a down cycle in bioprocessing that's still in the process of swinging upwards. But more important than that is that their balance sheet is pretty flexible right now. Mm-hmm. So their leverage is low, and in an environment where valuations for their competitors have come down, this is one of the best acquirers in the world. So you have balance sheet optionality along with a great diversified portfolio, and they're missing the clinical piece and the clinical production piece, but at the same time, that's actually the toughest part of the ecosystem right now. So there's an opportunity for this business to really complete its full portfolio at an opportune time in the market.
And you said there's been a downturn in medical research?
Basically, yeah. So the production of, bioprocessing production, mm-hmm. there has been a bit of a downturn. So there's different parts of the ecosystem that you play. Sure. So the bigger medical equipment tends to be more academic, more labs, mm-hmm. and then there's the actual production of the drugs itself and test batches and the like. There's been a bit of an inventory buildup there that they're working through over the last 2 years.
Your next idea is GE Aerospace. Mm-hmm. At least that's what it's called on the New York Stock Exchange, and they're huge in aircraft engines. Exactly.
And I told you that it's a lot easier to order the plane than to build it.
Yeah.
GE Aerospace is a bit of a more diversified footprint in the aerospace conversation. So it's not just new plane production. They have a big aftermarket business. So even if you can't deliver the new LEAP engines, the legacy engines still need servicing mm-hmm. and need to be rebuilt from basically the ground up from different periods of time. So you have a more diversified aerospace opportunity in the case of GE Aero, as opposed to something very pure play in new production like Boeing would be. Mm-hmm. So I think GE Aero offers you the best of the new production along with the aftermarket in a company that's really come into its own.
That's interesting, yeah, because servicing engines and rebuilding them, and I guess doing parts and stuff like mm-hmm. that.
And it's high margin. That's really where the margin is over time. And that's what Boeing was trying to do years ago, but it got scuttled with the crashes of the 737.
We just looked at the TMX Group hitting a record high today. CME Group, an exchange. Mm-hmm. You like the look of this equity as well.
Yeah, and GE pretty aggressively positioned. Danaher is an idiosyncratic balance sheet opportunity today. CME Group is, if you want a bit more diversification in the portfolio, a company whose cash flows go up when the market's more choppy like it is today, this is the type of company for you. So they are they're effectively the monopoly on the Treasury futures market. So as more questions about Treasuries come into play, investors trade more. That's more cash flow for CME. So think of this as the defensive counter-cyclical exposure in your diversified portfolio, with GE Aero being the industrial risk-on growth impulse part of the portfolio.
So they're a huge player in the bond market, as
yeah, bond futures, yeah.
Bond futures. That's interesting. Yeah, these exchanges, they tend to just reap fees. They're toll keepers in mm-hmm. some ways.
And they're natural monopolies. That's the other part to really take into account and take stock of, is there's no competitor for CME for their products because of how the clearinghouses functionally work with what's known as trade compression and cross-margining of collateral. So you can't underprice CME enough. You could even give the futures contracts away for free, and clients still wouldn't move their money out.
Because the liquidity's at CME, but also the whole system is set up.
The collateral cross-margining is a really important piece of it, because if you can net off one exposure versus the other, then your capital is far less than if you had to put both trades on at the same time. That's a very nuanced and in the weeds point to make, but it is foundational to why clearing exchanges are effective monopolies.
That's interesting. I wonder, have the regulators ever done anything about that?
They can't.
Yeah, because that's just the way it is. Mm-hmm. Yeah, that's interesting.
If you're long one future and short the other, would you have a notional exposure of $100 against one and the other, or would you have a net $25 exposed? The math just doesn't work to compete against CME.
That's interesting. What about TMX Group? Would you be a buyer of that stock right now?
No, it's totally a different business. So, and I sorry to jump on you on that point.
No, great.
But I think the way to think about TMX Group is it's not a clearing exchange. There's a clearing element to it, but it's got a business that's centric towards more equity transactions. So that tends to be a lot easier to compete with. So TMX Group has a pretty dominant position in Canada.
Yeah.
They've got a good platform asset in the case of the Illyrian MLP index through their recent acquisition. But TMX Group is more a scarcity play in Canada, but relative to the other exchanges around the world, it is on the second tier of exchanges versus the clearing assets. So the Euroclear, which is Deutsche Börse, when it comes to the natural gas and the oil business, which is Intercontinental Exchange. And then when we talk about the London Stock Exchange with the interest rate swap business, and then CME with the Treasury futures business, those are tier one assets. TMX Group, Euronext, the New York Stock Exchange, which is ironically part of the ICE conglomerate as well, not to complicate the conversation.
Yeah.
Those are tier two, because you can compete against a listing exchange, you can't compete against a clearing exchange. So TMX Group, truly think of it as a Canada scarcity conversation, but it should be at a significant discount versus its other peers.
Right. I mean, there are.
So I think it's a little rich right now.
Sorry, John. Yeah, there are. I mean, the CBOE has an equity exchange, but the TMX still dominant in equities.
Exactly. And CBOE, TMX, it's really just jurisdiction.
Sure.
So think of that's a perfect analogy of the CBOE when it's actually the BATS business, part of CBOE. They're very much the same thing. So long way of saying, listing exchanges are very easy to compete with, and there aren't the same competitive advantages that they have. Clearing exchanges are in a league of their own.
Dan, thank you very much. We always learn a lot. And Dan Rohinton, Portfolio Manager at IA Global Asset Management, coming up at